Okay, let's just imagine this for a second. You're drowning in debt, right? The phone is ringing off the hook with collectors, and then you see it, an ad, an email, something promising to settle your loans for just a fraction of what you owe. It sounds like a total lifeline, doesn't it? But here's the big question. What's the real price you pay for that relief? Does loan settlement really destroy your credit score? Well, we're going to dig in and find out the truth that, nobody seems to talk about.
All right, let's just rip the Band-Aid off right away. 160 points. For someone with a really good credit score, let's say a 780, just one dead settlement can slam your score by up to 160 points. Poof, gone. I mean, that's not just a small dip. That is the difference between getting a great rate on a mortgage and maybe not even qualifying for a loan at all. This number right here, this is the core of what we're talking about today.
So if the damage can be that bad, you got to be asking, why on earth would anyone do this? Well, it's because when you're completely overwhelmed by debt, that settlement promise, it looks like the only way out. So let's get into it. What exactly is this promise, and why does it sound so darn good?
Okay, so what is debt settlement really? At its heart, it's actually pretty simple. You, or more often, a company you hire, go to your creditors and basically say, look, I can't pay the full amount, but I can give you this lump sum of cash right now. If they agree, they take the smaller payment, close out your debt, and forgive the rest of what you owed. I mean, on the surface, that sounds amazing, right?
And this really gets to the why. Why is it so appealing? Well, think about it. First off, you get to pay less than what you actually owe. That's huge. Plus, it's sold as being way less scary than bankruptcy. And maybe best of all, those non-stop collection calls finally stop. It's basically pitched as hitting the reset button on your finances, a totally fresh start.
Okay, but, and this is a huge but, here's where we get to the catch. That amazing relief we just talked about, it comes with a seriously steep price tag. A price that can literally send your credit score tumbling right off a cliff. And you know what? This is the part that settlement companies don't always shout from the rooftops.
So what's the secret? What causes all this damage? Well, here it is, the hidden first step. Almost every single debt settlement strategy requires you to stop paying your bills. Yep, you heard that right. You have to intentionally become delinquent. Why? Because that's how you convince the creditor you're in real financial trouble and force them to negotiate. But every month you don't pay, bam, another late payment gets reported, and your score just tanks.
And this right here is what we call the cliff effect. Just look at this data from FICO. If you start with a fantastic 780 score, you have so much further to fall. A drop of 140 to 160 points is, well, it's catastrophic. But now look at the person with a 680. Their score drops too, but only by maybe 45 to 60 points. So what's the deal? It's because if your score is already lower, it's kind of already priced in that you're a bit of a risk. The person with the 780, they look perfect until they suddenly aren't.
Just to really hammer this home, imagine seeing your score go from a stellar 780 all the way down to 620. That is a massive shock. It completely changes your financial identity and flips your ability to borrow money completely upside down.
Okay, so the damage is done. Your score has taken a hit. The next logical question is, well, how long is this going to haunt me? This negative mark, it casts a really long shadow on your credit report. But understanding exactly how that timeline works is super important.
And this is where we hit a really common misunderstanding. People think the 7-year clock starts ticking the day you finally settle the debt. Nope, that's not how it works. The clock actually starts from the date of your first missed payment, the one that started this whole mess. So let's say it took you a full year of not paying before you reached a settlement. The good news? That means you only have 6 years left, not 7, before that whole thing disappears from your report.
But even when the balance says 0, there's still a little ghost left behind. See, future lenders will see these little notes on your report. Phrases like, settled for less than full balance. Think of it like a permanent footnote on your financial history. It's a huge red flag for them because it says, hey, this person didn't hold up their end of the original deal. It's basically a record of broken trust, and that makes them very, very nervous about lending you new money.
All right, I know that was a whole lot of doom and gloom, but please stick with me because this next part is probably the most important thing we'll talk about today. You can recover from this. The journey to rebuilding your credit, it literally starts the moment that debt is officially settled.
And here's the thing you have to remember. Your credit score is not a tattoo. It's not permanent. It's more like a living, breathing number that changes based on what you do. A settlement is for sure a serious black mark, but it's an event you can 100% come back from as long as you've got a little discipline and a solid game plan.
So, what's the plan? It's basically 4 simple steps.
Step 1, you need to watch your credit report like a hawk. Make absolutely sure that settled account is marked settled and shows a zero balance. Step 2, you have to start adding new, good information to your report. That means opening a new, simple line of credit. Step 3, from that point on, your payment history has to be flawless. We're talking every single payment, on time, every single time. And finally, Step 4, keep the balances on any new cards super low. This is how you prove to the world that you can handle credit responsibly again.
So what are these rebuilding tools I'm talking about? Well, the two most common are a secured credit card and a credit builder loan. A secured card is basically a credit card with training wheels. You give the bank a cash deposit, say $300, and that becomes your credit limit. A credit builder loan is kind of the reverse. A bank gives you a tiny loan, but they hold the money in a savings account. You make payments on it for a few months, and once you've paid it all back, they release the money to you. The whole point of both of these is just to get positive payments showing up on your credit report.
Okay, so we've looked at the tempting promise, we've seen the painful price, and we've laid out the path to recovery. Now it's time to put it all together and get to the final verdict. Is doing a debt settlement actually worth it in the end?
It's really important to remember that settlement is just one tool in the toolbox. You've also got things like debt consolidation. That just rolls all your debts into one new loan, and the credit hit is usually much milder. Then there's bankruptcy, which is the most serious option for sure, but it also gives you powerful legal protections from lawsuits, something settlement doesn't do. See, they all fit different situations. Settlement's one big claim to fame is that it's the one that actually reduces the total amount of money you have to pay back.
And so that really brings us back to the ultimate question, doesn't it? Is that instant feeling of relief from all that crushing debt, is it worth the 7-year shadow it casts on your finances? Is it worth that massive 160-point hit to your credit score? Honestly, there's no easy answer here. It really truly depends on your specific personal situation. But the most important thing is that now you know exactly what you're trading away. You know the full cost of that choice.